Welcome back to the deep dive. Okay, so you've got this pretty dense package from Atul Auto Limited, right? It covers their Q1 for fiscal 26, ending June 30, 2025.
That's right. We've got the unaudited financials, corporate announcements, the whole lot, approved by their board on August 7th.
And it looks like, there are two really different stories playing out here.
Exactly. The filings themselves, the financials, and the limited review report, they're required by SEBI rules, Regulation 3033, standard stuff for transparency.
So our mission today really is to cut through that complexity. We want to look at, one, the core business. How's the actual auto rickshaw manufacturing doing? That's the standalone results. And two, we need the bigger picture, the whole ecosystem. Finance, green tech subsidiaries. That's the consolidated view.
And the contrast is, well, it's pretty stark. You'll see.
Before we dive in, maybe just a quick note on scale. We'll be talking in lakhs.
Ah, good point, yes. So 1 lakh is 100,000. When we say 13,509 lakhs in revenue, that's 135.09 crore rupees. We're dealing with pretty substantial numbers here. Millions, essentially.
Okay, perfect context. Let's start with governance then. Seems like the August 7th board meeting wasn't just rubber stamping numbers.
No, not at all. They made a key decision about compliance. It looks like they're strengthening their regulatory setup.
What do they do?
They appointed a new secretarial auditor, Ms. Hardik Huda and Associates, based in Ahmedabad. They're practicing company secretaries.
Right. And what caught my eye was the term, 5 years. That seems quite long for this kind of role. FY 2025-26 through 2029-30, of course, subject to shareholder approval.
It is a long commitment. It definitely signals stability, maybe looking ahead strategically. This firm, Hardik Huda, they have over 10 years experience specializing in company law, SEBI regs, but also, interestingly, intellectual property rights, IPR.
IPR.
For making auto rickshaws. That feels a bit specific. Why the emphasis there? Well, that's the intriguing part, isn't it? For a standard manufacturer, maybe less critical. But remember, Atul Auto has those other ventures.
Ah, right, the green tech subsidiaries.
Yeah.
Like Atul Green Tech.
Exactly. So if they're developing new EV designs, maybe battery tech, unique leasing approaches,
Yeah.
protecting that IP becomes absolutely crucial.
So this 5-year appointment, especially with the IPR focus, it's maybe less about standard compliance and more about guarding future innovation, especially in electric vehicles.
That's how I read it. It's like they're building a fence around their future tech plans. It ties governance directly into their green growth strategy.
Okay, that's a really important angle, something for you, the listener, to keep in mind, not just box ticking.
Mm-hmm.
All right, let's shift gears to the core business itself, the standalone results, just the manufacturing and selling of three-wheelers. No 3 confirms it's still their single segment there.
Yeah, the core engine. And Q1 gave us this interesting mix. Slightly lower volume, but better financial performance.
Okay, units first. Sales volume dipped a tiny bit. 6,568 three-wheelers sold this quarter.
Compared to 6,651 in Q1 last year. So yeah, a small drop. Market demand wasn't surging, apparently.
But, and this is the key part, revenue actually went up. Gross sales climbed from about 125 crore, or 12,466 lakhs, to 135 crore, 13,509 lakhs.
Total revenue from operations also up to 13,691 lakhs.
So selling slightly fewer units but making more money overall. That screams, well, better pricing, or a richer product mix, right? Maybe more expensive models.
Exactly. That's likely pricing power or a favorable shift in what they sold. And critically, this flowed down to profits.
Right, the bottom line, profit before tax, PBT, improved. It went from 606 lakhs last year to 656 lakhs this Q1. An 8% jump.
And for shareholders, the basic earnings per share, EPS, also saw a healthy increase, 1.64 up to 1.77.
Which tells us the core manufacturing operation itself is running more efficiently, more profitable per vehicle.
It seems so. And what's notable is how they managed it. Looking at expenses, the cost of materials consumed was basically flat, just over 10,400 lakhs in both quarters.
So raw material costs held steady, but they got more revenue per unit. That's good margin expansion. Suggests solid cost control. And, yeah, that favorable mix or pricing.
Definitely points to strong operating performance in the core unit.
We should also probably touch on other income, though it's smaller. Note 4.
Yes, worth mentioning. Total other income was 139 lakhs. The bulk of that, 110 lakhs, was interest income.
So they're managing their cash effectively, too.
Seems like it. Plus a 20 lakh corporate guarantee fee. So it adds a bit, showing good treasury management alongside the manufacturing strength.
Okay, so that's the standalone story. Efficient, profitable core business. Now, the plot twist. Let's look at the consolidated results. This is where things get complicated.
Right, because now we bring in the subsidiaries and the picture changes quite a bit.
Which entities are we consolidating here? Remind us.
Okay, so there are four. Two wholly owned, Atul Green Automotive Private Limited, and the big one, Khushbu Auto Finance Limited. That's their NBFC, their finance arm.
NBFC, non-banking financial company. Got it.
Then two majority owned, Atul Green Tech, which is about 79% owned, and Atulis, which is 80% owned.
Okay, so consolidated top line first. Revenue jumps up significantly, doesn't it?
It absolutely does. Consolidated total revenue reached 15,278 lakhs. Compare that to the standalone's 13,691 lakhs.
And where's that extra revenue coming from mainly?
Primarily the finance business. The consolidated statement explicitly shows 11,114 lakhs as income from finance business. So Khushbu Auto Finance is a major revenue driver for the group. Diversification is happening at the top line.
And this is the paradox. The profit doesn't follow. Consolidated profit before tax is way down.
Yeah, it's striking. Standalone PBT was 656 lakhs. Consolidated PBT, only 325 lakhs, less than half.
Despite much higher revenue. Where did all that profit go? Did costs explode somewhere?
It's one specific cost line that really stands out, introduced by the finance subsidiary. It's loan losses and provisions.
Ah, okay. How big was that?
For Q1 FY26, 495 lakhs.
Wow. 495 lakhs set aside for potential loan defaults. Nearly 5 crore rupees. That sounds high. Is that normal for them?
It's a very significant number. It basically wipes out a huge chunk of the profit generated by the core manufacturing business. High provisions like this typically mean the NBFC expects more customers might struggle to repay their vehicle loans.
So it points to potential stress in their customer base, the people buying the rickshaws on finance.
That's the implication. This single expense line is the main reason the group's overall profitability tanks compared to the standalone unit. And you see it in the EPS, too. Consolidated ETS is only 1.06.
Compared to 1.77 for the standalone? Ouch. So the finance arm brings revenue, yes, but also significant risk and currently a big hit to profit.
Precisely. Volatility comes with that diversification.
Let's use the segment reporting to get even clearer on this. The consolidated results break it down into two segments, right?
Yes, automobiles and non-banking financial business, the NBFC.
Okay, so what were the PBT contributions from each segment in Q1?
The automobile segment reported a PBT of 260 lakhs.
Hold on, 260. But the standalone PBT was 656 lakhs. Why the big difference just for the auto segment?
That's due to consolidation accounting. Things like intersegment eliminations, allocating group overheads. These adjustments bring the reported segment profit for automobiles down from the standalone figure to that 260 lakhs.
Okay, makes sense. So 260 lakhs PBT from auto. What about the NBFC segment?
The non-banking financial business contributed 65 lakhs in PBT for the quarter.
Only 65 lakhs. After generating all that revenue.
Well, remember that massive 495 lakh provision expense sits within that NBFC segment calculation. That's what drags its contribution down so much.
Right. So 260 from auto plus 65 from NBFC gives us the total consolidated PBT of 325 lakhs. It matches up.
Exactly.
But look at the assets tied up in each segment. The NBFC might have low PBT right now, but it represents a huge capital investment.
It does. Segment assets for the NBFC are 24,277 lakhs, so about 243 crore. Compare that to 44,028 lakhs for the automobiles business. It's a significant chunk of the group's balance sheet dedicated to finance.
Which currently is yielding pretty low profits relative to that big provision charge.
That's the picture this quarter, yes.
And there was one more detail, an accounting nuance you flagged, about Ind AS, Indian accounting standards.
Yes, it's important for understanding the reporting complexity. The auditor's review report mentions that Khushbu Auto Finance, being an older NBFC, isn't actually required to comply with the latest, strictest Ind AS standards, unlike many others.
So it doesn't follow the newest rules. How is its data included then?
Its financial data is adjusted and presented according to the parent company's accounting policies specifically for the purpose of consolidation. It's not reported under standalone Ind AS.
Why should we care about that detail? Seems technical.
It matters for transparency and how you assess risk. When a significant subsidiary isn't on the most current, rigorous accounting standard, you're relying more on the parent's interpretation and adjustments to understand its health.
Especially when you see a huge provision like that, 495 lakhs.
Exactly. It potentially adds a layer where understanding the true granularity of the loan book quality might be slightly less direct. You have to trust the parent's consolidation process is robust and accurately reflects the situation.
Okay, that makes sense. It underscores the complexity of analyzing the group versus just the core.
Definitely.
So let's wrap this up. It really is a tale of two companies within one group. On one hand, the standalone manufacturing business.
Yeah, looking quite solid. Stable volume, improving efficiency, better profitability per unit, EPS up nicely from 1.64 to 1.77. Seems like a well-run operation.
But then you layer on the rest of the group, especially the finance arm.
And the picture gets messy. Consolidated revenue is boosted significantly by that finance income, but the group's overall profit gets hammered by those loan losses and provisions. 495 lakhs is a big warning sign.
It drags the total group profitability down, resulting in that much lower consolidated EPS of 1.06.
It really highlights the risks that come with that finance diversification.
And the board spent a decent amount of time on this 82 minutes, based on the start and end times in the filing, 11:31 a.m. to 12:53 p.m. They clearly had things to discuss.
You'd think so. They locked in that 5-year governance partner, maybe looking ahead to the complexities of green tech and IP. But the immediate financial reality is that the finance segment, while driving revenue, is also showing signs of stress.
Okay, so here's the final thought for you, the listener, to chew on. We know the core manufacturing business depends heavily on people being able to buy those three-wheelers, often using financing.
The two are intrinsically linked.
So could the stress we're seeing in the finance arm, reflected in that huge 495 lakh provision, actually be a kind of early warning signal, a leading indicator for what might happen with future vehicle sales or credit quality in the core business itself?
That's the million-dollar question, isn't it? How tightly correlated are those risks? It's definitely something to watch closely in the upcoming quarters, that potential feedback loop between finance stress and future manufacturing performance.
Keep that connection in mind. Thanks for joining us on the Deep Dive.